Welcome. Thank you for joining us. We'll give just maybe less than a minute for a few more people to join us on this webinar, and we're going to have a great time today. In the meantime, let me show you something. We're going to want you to download the answer sheet. You'll go to theportfolioprotectionstore.com/answer sheet. So go to your computer and type in theportfolioprotectionstore.com/answer sheet. You'll just download and print that form if you're able to. If you're not able to, if you could just take a piece of paper and a pen, because we definitely want you to take notes in order to get the maximum value out of this workshop. And if you can't take notes, that's okay. But I promise you'll get a lot more out of it if you can take notes. And we're going to have a methodical way of taking notes throughout this workshop. So while we wait for a few more people to shuffle in, maybe a joke or two. What do dentists call x-rays? Toothpicks. Have you heard a construction joke recently? Probably not, because it's still under construction. And one more. What did one ocean say to the other ocean? Nothing. It just waved. All right. For those of you just joining us, if you can, in the red block down here, you'll want to print at www.theportfoliostore.com/answer sheet. Right there. You'll go to that website. You'll print out the answer sheet. You can do that while I'm talking. This slide will be up for a few more seconds. This workshop is going to be about portfolio protection and safe money ideas for retirees. Brought to you by the Portfolio Store. I'm Mike Massey, your host, and this is the place where smart investors go to protect their life savings from stock market losses. All right, let's get going. So this is our disclosure page. We're going to look at this before we begin. The content is for general informational purposes. It is not intended to provide fiduciary, tax, or legal advice. Investment and insurance products are not FDIC insured, not insured by any federal government agency, not a deposit or other obligation or guaranteed by a bank or any of its affiliates, subject to investment risks, including possible loss of the principal amount invested. I'm going to let you read the other three paragraphs by yourself so as to save my voice for the workshop, or else it's going to go and I won't have anything left. So I'm going to let y'all read that for about a minute, and then we'll get on with the presentation. All right. If you need to read that anymore, just email me at mike@theportfolioprotectionstore.com. Mike@theportfolioprotectionstore.com, and we can get you that slide. You can memorize it if you want to. Who am I? Mike Massey. I have a law degree. I have a master's in business. I have a master's in accounting. I've been married for 17 years, definitely one of my greatest accomplishments. My parents have been married at this point 56 years. And I hope that my wife and I get to live long enough that we would also be married that long. I think it's just an incredible achievement. 5 kids. We have 2 in heaven. One of our, on top of the 5 kids, we have 2 in heaven. One of our living children is from Ethiopia. We have a Chihuahua, a Russian tortoise, 2 bearded dragons, but no partridge in a pear tree. I'm an entrepreneur. I have over 3 very successful businesses. I have been in the investment business for about 20 years. I'm a Christian. I'm saying it right here, right now. I'm actually an ordained pastor. I host a daily Bible podcast called Verse by Verse. Daily Verse by Verse. You can look it up on any major podcast platform. Just for example, if you go to Spotify and type in Daily Verse by Verse, this is it. And you just subscribe, follow, do whatever you want, but just kind of telling you about myself. This is my passion. This is what I love. All right. I also host a men's Bible study every Friday morning, and every Sunday morning I am teaching the 7th grade boys at our church. The best part of my job is helping people decrease stress and increase joy. My life goal is to glorify God by serving and loving others. Let's have some fun with this workshop today. But before we begin, where did my slide go? Let's look at my family. I'm going back and forth on the slides. My apologies. So here's my family. Here's my beautiful bride of 17 years. Her name is Jen. And here is Luke. He is my oldest son, 13 in the 7th grade. We've got Grace. She just turned 8. We've got Cabe, who is 7 years old. And we've got Ava, who is 5 years old. And then we've got new baby Mac right here. He's just a couple months old now. Love my family so much. All right. So my daughter just learned to ride a bike. She didn't want to. She had the training wheels on. She was scared. She's like, Daddy, we can't take them off. And even with the training wheels on, she still wanted me to hold the handlebars of that seat because it would rock and sway a little bit. And she wasn't comfortable with it. It made her fearful. She didn't understand the unknown. She was afraid of crashing. She was anxious. She was insecure. Finally, I said, daughter, please, let's learn to ride your bike. I think you're just going to love it so much, but I need you to trust me. And I think you're really going to enjoy it. So we went up to the football field. We threw off the pads, the knee pads, the elbow pads. We kept the helmet on, took the training wheels off. And here's what we're going to see. Check this out. Keep going. Keep pedaling. Pedal faster. It'll straighten out. Oh, keep going. Right. So, oops. Before, she was fearful. She was worried about crashing. She was anxious, insecure, just fear of the unknown. Well, we talked about that forward progress, not looking to the side, not focusing on your circumstances, not looking behind you, just keeping your head down and going forward. I told her that she would enjoy it if she would just trust me, trust the plan, and just relax. And guess what? She did. She loved it so much. And now every day she wants to go out and ride her bike. Well, you see, that's a lot like investing. That's a lot like retirement, is just making sure that you get rid of that fear that's crushing you and that fear of the unknown. And I know many of you may be worried about crashing with your portfolio, crashing in retirement, something like that. You're anxious. You maybe don't sleep well at times because of your finances in retirement or illness or anything like that going on. Now, we can't solve all your problems, but what I can promise is we can have an open and honest conversation to see if we can help you, if we're a good fit for each other. We don't take on all the clients that come to us. We're very selective in the clients that we choose to work with. And those that we want to work with are the ones who learn to trust us. And the result is going to be enjoyment and joy. And we're going to have a great plan. You're going to be able to relax more and just enjoy retirement more. So just think about my baby girl who we took the training wheels off and now she's really loving it. And I think that's what we do with a lot of investors and retirees, is really help them get comfortable with the unknown, comfortable by having a better plan, comfortable and taking away, putting on that helmet, if you will, that's going to protect you. So we'll talk more about that. All right, so let's get into rising prices and inflation. So from 1960 to 2021, that's roughly a 61-year period. The average rate of inflation was 3.8%. But check this out. In the 1970s, it was 7.25%. That's a big number. And do you know what it was from August 2021 to July 2022? 8.5%, bigger than it was in the 1970s. It's a huge number. So here's the question for you, and why this is going to be an interactive workshop. And I think you'll learn as much or more than you ever have from any workshop you've ever gone to, because I want you to think, I want you to write down your thoughts, your answers, because it's going to better facilitate our conversation when we have that conversation. So I want you to grab that answer sheet right now. I want you to pull it up, and I'm going to show you what mine looks like. It's going to look the same as yours. Number one, it says inflation rate expectations. I want you to write your answer here. What do you think? I'm going to pull it down. What do you think inflation will be, right? For 61 years, it averaged 3.8%. In the 70s, it averaged 7.25%. And just over that 12-month period right here, it was 8.5%. So what rate of inflation do you expect? Write your answer in there. Is it 1%, 3%, 7%, 10%? Is it one of the numbers we reviewed? Write that down. Okay. Next slide. Withdrawal rate. If you're taking $50,000 on a $100,000 portfolio, that's a 5% withdrawal rate, right? Because 50,000 divided by $1 million, for example, is 5%. Your withdrawal amount divided by your portfolio value equals your withdrawal rate. So what is your withdrawal rate? So if you are taking 30,000 on $1 million portfolio, that's 3%. Write those numbers in there. If you're taking 20,000 on a $500,000 portfolio, that's a different number. Write that number in. If you have a $10 million portfolio, et cetera, you get it. I'll let you write the answers in. And don't be distracted by what I'm saying, but I also don't want silence, because you out there in workshop land are going to be like, wait, it's silent. What happened? It froze up? No. Okay. So write down your withdrawal rate. And you're going to write that down on line 2. You see how it's going? You're going to have these answers that you can actually look back once we're done with the workshop, so you can start thinking about these and have conversation with yourself or with your spouse, and you'll just be a lot better for it. All right. Let's talk about exploring drawdowns. Over 50% of the time from 1980 to 2021, that's about a 41-year period, did you know that the S&P lost 10% or more intra-year? That means on average, about 50% of the time, about every other year, on average, the market went down, as measured by the S&P, went down more than 10% from its high to its low during that year. Okay, comfortable with that statistic? Let's go to the next one. The S&P actually drawdown during 2008 was 48%. It's a big number. That means if someone was invested just in the S&P, they lost almost their entire, or almost half of their entire life savings that was invested in the S&P. The S&P declined from October 9th of 07 through March 9th of 09 was 56.8%. That's over half. So someone who said, I just trust the S&P, I want to be in it, they would have had to go through that and stomach a 56.8% loss. How many of you could sleep at night if you lost 56.8% of your portfolio, especially if you were in retirement? Maybe you're comfortable with that when you're 20 or 30 or 40, maybe 50, but how about 60 or 70? Let's look at the next one. From January 2022 to October 24th, 2022, the Bloomberg Aggregate Bond Index, which is generally known as a benchmark for what bonds have done in the United States, it was down 15.78%. Bonds. You get that? Bonds, on average, down 15.78% as measured by that. And long-term treasury bonds, you know, the ones guaranteed by the United States government, we're down 34.8%. Doesn't change the guarantee by the government, but it affects the value at which you could sell it if you sold it early. That's a big number. Maybe you don't think it is, but a lot of people do. So here's the next question for you. What drawdowns do you expect? S&P, on average, half the time loses more than 10% in a year. During 08, it lost 48%. During this time period, 56.8%, and just bonds went down 15.78%, and treasury bonds, long-term treasury bonds, 34.8% over those respective time periods. So what drawdowns do you expect in retirement? And I want you to write that down here on number 3 of your answer sheet. Go ahead and write that answer, and I'll leave this slide up for a minute if you need to refer back to it while I take a sip of water. All right, we go to the next one. Let's do math. One of my favorite slides. Starting value. Let's assume it's $1 million. And let's assume your growth for that year was 70,000, right? You're in, I don't care if it's bonds or equities or a combination. We're just making numbers that make sense to you. 70,000. So there's no loss for that year because you gained. And let's say inflation was 30,000. That represents a 3% rate of inflation. And let's say your withdrawal was 4%, which was 40,000. So what is your purchasing power at the end of the year? You started with $1 million. It grew by 70,000. Inflation ate away at 30,000 of that purchasing power. You took out 40,000 to live on. You still have your $1 million. So you made 7% growth rate, but you're right back where you started because of inflation and your withdrawal to live on during retirement. Let's walk through a different scenario. You have $1 million. You didn't grow. You actually lost money that year. Went the other direction. Woohoo! Sad. Of course, we never want to see this, but it happens. Went backwards 7%, $70,000. Again, we're saying inflation was 33% or $30,000 on that portfolio. And the withdrawal $40,000. So now you're only left with $860,000. So you're saying, wait, I only took out $40,000, but I've only got $860,000 of purchasing power. Why? Because inflation ate away at 3% of it in our example, and you lost 7% of it in our example. So now you're down 14% behind the 8 ball. That's a huge problem, right? That's a huge problem. So now I want you to do some math. I want you to say a starting value. Maybe it's $1 million. If it's not $1 million, and you can cross out of $1 million, but I want you to write down on paper what your portfolio value is, what you think your growth or loss, and you can walk through 2 different examples, could be in a given year. Inflation, again, we went back. The long-term inflation is not 3% as in, this example, but 3.8%. In the 70s, it was over 7%. And from basically the middle of 21 to the middle of 22, it was over 8%. And then take out your withdrawal, whatever your withdrawal is on your portfolio value, and find out what your purchasing power is. So I want you to do that math now. And you can go to line 4 here. So what's your potential purchasing power after a year if you subtract lines 1, 2, and 3 from 100%? Okay. So if your inflation rate expectation up here was, and I'm making this up because I don't know what you wrote down. It's particular to you because I can't predict the future. I don't have a crystal ball, and neither do you, but you're going off your best expectations because that's where you're going to find your greatest comfort level and make the best decisions. So let's think about this. Let's say the inflation rate expectation, let's say you wrote down 4%. And if your current withdrawal rate is 4%, and if your drawdown expectation, maybe you said, hey, I expect to draw down 10%, which is the 50% of the time it does that during the year. You may have said, hey, I'm already down 20 or 30% right now. Let's put that number in, or worse. We saw the S&P go down over 56% or over 54%. So add those numbers up. That's the potential purchasing power after a drawdown, inflation, and withdrawal. That's that number. I want you to think about that. Do you sleep well thinking about that number? Does it give you pause? Does it give you worry? Does it give you anxiety? And it's okay to be honest. We want you to be honest because we're only dealing with your life savings and your ability to stay retired or get retired with the dignity and the lifestyle that you want and that you deserve, right? Okay. So how do your inputted numbers make you feel? Good or great, pretty good, uneasy, or worried? I want you to write that on line 5. So go back to your worksheet. How does that number that you wrote down in line 4 make you feel? Great, pretty good, uneasy, or worried? Write that down. So right now you should have 5 answers over here. All right. So you can go ahead and book an appointment with me now. You can flip over to your browser if you're on a computer, or you can go to your phone. It's very simple. Type in Calendly, calendly.com/portfolio protection. Calendly.com/portfolio protection. Because 30 minutes with me could change your life. We fill up fast, and this is on a first come, first serve. There's a lot of people on this webinar, so go ahead and book. All right, we will show that slide again if you missed it. Living too long? Let's look at the chance of living to age 90. Everybody's like, no, I'm not going to live that long. My dad, I'll tell you a funny story. So my dad used to say, I think I'll make it to, he had an age and I can't remember it in my mind. I think it was like 68 or 70 or something like that. I said, Dad, why do you think you're only going to live it to that long? Your dad lived to like 96 and your mom lived, she passed pretty early, but why do you think? And he's like, well, not in the greatest health and this and that. And I'm like, Dad, you're going to live longer than that. I just have a feeling. He's like, well, I don't think so. Well, now that he's going to be turning 79 next month, I'm like, Dad, how long do you think you're going to live now? He's like, man, I think I might be able to make 90, right? So expectations can change on your own life expectancy. A doctor doesn't know how long you're going to live. God does, but God's not telling you how long you live because he wants you to use every moment that you have for his glory and not just sitting around and waiting or being sad about when you're going to pass away. But what we do have to think about is how long might I live? What age might I pass away at? So check this out. There's a 43% chance for a 65-year-old male to live to age 90. That's probably a lot bigger chance than you thought. And there's a 53% chance for a 65-year-old female to make it to age 90, right? Females age 65 are expected to have a higher chance of living to age 90 than a male, but both of them are in, that 43, 53% range. That's a big number. Now check this out. If there's a couple, there's a 73% chance that one of them makes it to age 90. If you're 65-year-old couple right now, a 73% chance that one of you makes it to 90. That's probably living longer than a lot of you thought. And if you're watching this as a husband and wife, you may be, nudging each other right now saying, see, I told you we should have planned better or saved more or this and that. But what we got to work with is what you've got, what you've saved. And that may be a ton. It may be 30 million. It may be 10 million. It may be $1 million. It may be 200,000. But what you have is important to you. And I'd love to have a conversation to see if we can help you. So here's our next answer and question for you. What's the longest you think you might live? And this is going to go on line 6 of our answer sheet. It's the longest that you think you will live. I want you to write that number down right here. And if you're a married couple and you're writing on the same sheet, you can go ahead and write those answers next to each other. Or you could have his answers and hers answers or her answers or her answers, whatever you got. Or you can have your own sheet. Okay. All right. Give you a sec. I'll take some water. All right. Here is a great withdrawal rate worksheet. This is basically like Monte Carlo analysis, essentially what we call it, which is what's the percent chance. Ignore this. What's the percent chance that your assets will last through your retirement? So let's say someone's going to live over here in this column, a 30-year period. And let's say they're invested 40% equities and 60% bonds. So it says stocks right here, 40% and bonds, 60%. Well, if they're taking 5% of their assets to live on, and they're expected to live a 30-year period, and they're invested 40-60, they only have a 20 to 30% chance of success. So the inverse is that says that there's a 70 to 80% chance of failure. What if you take less of your portfolio? That increases your chances of success. So if instead of taking 5%, you were taking 4%, we follow that over here. Now you've got a little better than a 50-50 chance. It's showing a 50 to 60% chance of success, which means a 40 to 50% chance of failure. And you say, well, I don't think I'll live 30 years. I think I'll live 20 years. Let's pick a different column. Let's say you're invested 60% stocks and 40% bonds, and you're taking 5%. Well, that's a 70 to 80% chance. So you can look at this chart, and we're happy to share it with you as well to get an idea. And we can also run more exact numbers for anybody who becomes a financial planning client of ours and see what those numbers look like based on your particular situation. But this chart is very informative and very telling for people to really understand and get an idea, at least a starting idea, of whether they're maybe invested too heavily in equities or too little, and whether they're taking too much out of their portfolio, their withdrawal rate, or maybe they could be taking more because they're taking too little. So just to give you an example over here on this 5% living for 30 years, if they're only 20% equities, it shows they have a 0 to 10% chance of success. That's not good. But if they're 100% equities and no fixed income, then they're, where's the number? 50 to 60% chance of success. So you can see these numbers. I want you to think about that. Now, let's talk about running out of money. What's the percent chance that your assets will last through retirement over a 30-year period, invested 60% in stocks and 40% in bonds, adjusted for inflation? From the chart that we just talked about, just with bigger numbers, because you may not have been able to read those numbers on that small chart. So we're going to blow up a couple of them. Oop. So the 4% withdrawal, living 30 years in retirement, invested 40% in fixed income, bonds, 60% in equity, stocks. It gives you a 60 to 70% chance of success, which means the balance is a 30 to 40% chance of failure. If you're in that category, are you comfortable with a 30 to 40% chance of failure in retirement? That means running out of money before you take your last breath. I know so many people out there say, "Hey, I want to spend my last dollar on my deathbed." Well, that's pretty much impossible to do because no one knows when their deathbed is going to be. And so you just can't. And so if people are like, I'm just going to spend, and I expect to die at exactly 89.2 years. Well, what if you live another 10 years past that? What are you going to do for income? You going to sleep on your kid's couch? You going to move in with your grandchild? What are you going to do? So these are what the things that we really want to think about when we want to have this conversation about. So the next answer on your answer sheet is, what is your thought regarding your withdrawal rate in light of your answers on lines 2 and 6? I want you to write this on line 7, okay? So line 7 is what we're filling in. So what are your thoughts regarding your withdrawal rate in light of lines 2 and 6 above? Line 2 said, what is your actual withdrawal rate? And line 6 is how long you're going to live, right? And if it's helpful, let me just go back to this chart. If we said, okay, here's your withdrawal rate, that's what you chose on line 2. And when do you think you're going to live, which is the oldest of you, the two of you, if you're a couple, 20, 25, or 30 years. This is kind of covers those time periods. And just follow those number down. How do you feel about that number, wherever your number lands? And I want you to write that in on line 7. Does it make you feel great? Make you feel okay? Does it make you feel worried? How does it make you feel? Okay. Now let's go to exploring random. I think this is the right slide. Yes. Exploring random returns from 1926 to 2021. Wow, that's a 95-year period. That's a really long period of time. 50% stocks and 50% bonds, according to Vanguard, returned an average of 9.3%. That's a great return. 100% bond portfolio returned 6.3%. Still a great return. But that's over a 95-year period. Let's look back through about a 20-year period, roughly. January 2000 through April 23rd of 2020, which is right after the kind of COVID started. Not the bottom of the market. The market bottomed in March of 2020 and started coming back up. The S&P 500 had gained only 5.4% over that roughly 20-year period. Now, over the 95-year period, 9.3, but over this roughly 20-year period, only 5.4. That's a huge difference, right? So if someone's planning on the 9.3, but during this 19.5-year period or so, they only got, and maybe that's a 20.5-year period, roughly 20 years, they only made 5.4% in the S&P. That's a huge difference versus expectations. What about investment grade bonds? They didn't do 6.3, they did 5.2. So here's another answer. What is your desired rate of return over time? And what is your maximum loss desired? Two different questions. So we're going to answer a couple different places right now. We're going to go to lines 8 and 9. I want you to write down your desired rate of return over time. And here's some long-term returns if that's helpful for you. Now on line 9, it's the maximum loss desired. Oops. What is your maximum loss desired? Is the most you desire to lose 30%, 20%, 10%, 0%? Write that in. Now let's go to lines 17 to 21. Line 17, do you think you could, what do you think you could make? Let me rephrase the question. I was reading it wrong. Regarding rates of return, how much do you think you can make with bonds and CDs over time? Here's the long-term, long-term average over that period, long-term average over this period. I want you to write in how much you think you can make with bonds and CDs over time. Number 18, how much do you think you can make with stocks and equity funds over time? I want you to write those answers in there. Verse 19, how much do you think you can make with annuities over time? I want you to write in that answer there. Maybe you have something in mind. Maybe you think it's 10% or 5% or 3%, or maybe you think it's 0, or maybe you think it's negative. I don't know, but I want to see that answer so that we can talk about it later. Line 20, how much would you like to earn over time? Just be realistic. How much would you like to earn? You don't say 15% because that's not realistic. It may happen for some people, but not something you can count on. Is your number 10%, 5%, 3%, 1%? I want you to write that number in there. In line 21, of your life savings, or how much of your life savings are you comfortable losing during a bad market? We already talked about this. If I can go back here, that the S&P during this period, during 2008, the S&P went down 48% from this period, which is roughly 17 months or so, went down over 56%. The bonds, just over this 9.5, roughly 10-month period, was down over 15%. Treasuries, long-term treasuries, down over 34%. So I want you to write in over 21, how much of your life savings are you comfortable losing during a bad market? Write down what that number is. Maybe it's only 10%. Maybe it's 50% or 60% you're comfortable losing of your life savings. Maybe it's zero. I want you to write down that number right there. All right. Thank you. Now we'll move on to the next. And all right. Goals. Please rank as crucial, important, or not important. And we're going to fill these in on lines 22 through 31 on the answer sheet. So let's go to line 22. 22. So please rank these as crucial, important, or not important. 22, you can read along with me. Making as much money as possible. I want you to write, is that crucial to you, important, or not important? Go ahead and write that in. 23, not running out of money. Is that crucial, important, or not important? 24, maximizing your financial legacy to your heirs, to your children, to your charities. Is that crucial, important, or not important? 25, is not losing over 10% of your portfolio crucial, important, or not important? 26 is not losing over 20% in your portfolio. You don't want to lose over 20%. Is that, well, if you don't want to lose more than 20%, is that crucial to you? Is it important, or is it just not important? 27. Let me see if we're still going to 27. Yeah, we're going to 31. Okay. 27. Lots of joy and low stress in retirement. Is that crucial to you, important, or not important? 28. Not paying much in fees. Is that crucial, important, or not important? And your answers don't have to be perfect. They're what you think they are, so that we can talk about them and formulate the best possible plan for you. 29, trying to keep up with inflation. Is that crucial, important, or not important? Maintaining your dignity in retirement. Is that crucial, important, or not important? And lastly on this list, having a reliable income stream to support your lifestyle. Is that crucial, important, or not important? Okay, I'll give you about 20 more seconds to answer any of those that you may have fallen behind on. You can always go back after the workshop and enter those. This is interactive. It's fun. It's exciting. It's a learning experience so that you can be a better you because of everything that you learn over time. And I would love to help you learn more and more. Let's go on. All right. All right. The Texas two-step. I'm from Texas. If you can't tell, I say the word y'all. I wear boots, have the hat, all that good stuff. All right. So let's do the Texas two-step. How much monthly lifetime income do you have from Social Security and pensions? Write that number in. For some of you, it may be 1,000. For some of you, it may be 4,000. For some, couples or even a single person with pensions, et cetera, it may be, I see this range anywhere from a couple $100 to 10 or 15,000 a month. Many people seem to fall probably, whatever, in a couple $1,000 range from Social Security or pensions. Most people don't have a pension. A few people still do. Second line, how much monthly lifetime income do you have from annuities? Is it 0? Is it 1,000? Is it 3,000? What's that number? In this third line, how much money do you spend monthly? Some of you are spreadsheeters, you use Mint, you know this down to the T. Great, put that number in. For the rest of you, you probably have a general idea. You're like, over a year, I think I make whatever, and I think I probably spend this. So take your best guess there of what you spend monthly throughout the year. So you could say, I think I spend $48,000 a year. It's $4,000 a month. So write that number in. So here's the math equation. This is the amount of income needs not covered by lifetime income. We also call this an income gap. This is the amount that's not covered by lifetime income. So step 2. Here's the question for you to answer. Would you like more guaranteed monthly lifetime income? And if so, how much more? Write that number in here. Again, be realistic. Don't write in $40,000 if you only have a couple $100,000 or a couple million in assets or whatever. But we can talk about all this. But how much more monthly lifetime income, right? Because Social Security is monthly income. It's for your life, guaranteed by the government. Pensions, monthly income for many people, guaranteed by the claims paying ability of the company. Not going into super details about all those, guarantees and stuff, just trying to give you an idea. From annuities, not all annuities, some annuities offer some form of lifetime income. And if so, they're typically backed by the claims paying ability of the issuing company. So how much more would you like? So the question for you, do you like mailbox money? Mike, what is mailbox money? All right, glad you asked. My definition of mailbox money is consistent monthly income deposited into your bank account or in the good old days of checks arriving in your mailbox, hence the slang term, mailbox money. Or if you're married and in Texas term, y'all's mailbox money, all right? So write your answer on lines 10 through 15. So those answers, we're gonna write right here on lines 10 through 15. What is your current guaranteed income from Social Security and pensions? Write that number. What is your annual budget, your expenses? Enter as a negative number. And what is your budget not covered by guaranteed income? Write that number in there, right? That's that income gap. That's that shortfall between what you spend and what you have in consistent guaranteed monthly income. And let's also go to line 13. Would you like more guaranteed income? It's a simple answer right here, right? Yes, no, or maybe. 14. If you would like more guaranteed income, how much more? Write that number in here. 1,000 a month, 500 a month, 7,000 a month. Write that number down. Line 18. Would you be okay with having limited access to some of your money? Right? Yes, no, or maybe. Having limited access to some of your money. And line 16. Let's see. I think line 16 is on this next one. Okay. So are you hungry for more? Do you want to learn more about how to create more guaranteed income? Go to line 16. You're getting the rhythm, getting in the rhythm, getting the hang of it. All right. Line 16. Would you like to have more guaranteed mailbox money? Right? Yes, no, or maybe so. My kids sing a song that's about that. Yes, so, or maybe so. I have to think. I'd sing it to you if I knew it, but I don't have a good voice. All right. Here we go. What's the maximum 1 year expense expected? So I want you to think about this. What's the most you think you might spend out of your portfolio for a house that you don't already have invested in a house? So for example, if someone has a $500,000 house, and let's say there's no debt, it's paid off, and they're going to move into a new house. If they were going to move into a $600,000 house that cost $100,000 more, then that $100,000 more would be a percentage of their portfolio. If they had $1 million portfolio, that's an extra 10% or whatever. So you can think about those numbers. So outside of your existing house, if you were to move into a bigger house, how much more of your portfolio might you need? Most of you would probably downsize your home. I see very few, I don't even know if I've seen it, who upsize once they're retired. They're 65 and they're like, you know what? I need a bigger house. I need more space. Everybody I meet, I think everybody, I can't think of any exceptions, although I'm sure there is an exception out there in my client base or peer group or whatever. People tend to downsize. So if they have that $500,000 house, they're going to go smaller and get a $400,000 or $300,000 house. So they have a $2 million house, they're going to go down to a $1 million house or an $800,000 house. So for most people, this is probably going to be 0, maybe 10%. But you put in, what's the most you think you'd pull for a house that essentially would be an upgrade in retirement? Or upsize. Start a business. What percentage of your portfolio might you spend to start a business in retirement? Well, most people who are retired that I know don't start a business. Maybe they have consulting and they start it with a couple $100, but then they just go out and work for their old company. Most people aren't going out and starting a tech company or starting some manufacturing company that requires massive amounts of capital infused. So for this, you might be like, hey, if I ever took money to start a business, it'd be 1% or 0%. Or, I mean, would you take 20% of your life savings if you were 65 and invest in a startup, knowing that most startups actually fail? Probably not, but you may be different. You may say, yeah, 20%. Again, this is up to you to put that number there. Major medical out of pocket. So some of you have insurance that would cover, some have Medicare that would cover, some have whatever. What's the most medical out of pocket beyond any insurance that you might have, whether it's private or government, that you might pay out of pocket? Do you think that might be 20% or 10% or 5%? Write that number down. And then the last one is, what's the maximum amount of your portfolio that you think you might use to help your family? Like a family member, a son, a daughter, a cousin, a brother, sister, something like that, or a parent. So what would you put here? If you put 50%, you're going to give half of your life savings to help your son in a jam? Probably not, but your number may be 50%. What about 20%? Would you expect to ever give 20% again of your life savings in retirement when you're retired or you're about to be retired? Would you just give that to them, hoping that they're able to pay it back, knowing that they may not be able to? Again, I don't see that very often. I see people help family to the tune of 1%, 2%, maybe 5%. It's very rare that, I've ever seen anybody give more than 10% of their life savings to a family member, not knowing if they're going to get it back, whether it's a loan or a gift or whatever. Unless, of course, they're ultra wealthy and we've got the ultra high net worth and they're trying to do it for estate tax purposes. But write down those numbers. So what's the maximum 1-year expense you might encounter as a percentage of your portfolio? And write this on line 32. So go to line 32. What's the expected maximum 1-year liquidity need? Add the percentage for house, business, medical, health, family, etc. So if you had, I'm making these numbers up, if you said, the most I'd come out of pocket is 10% for a house and 2% for a business and 5% for medical and 2% here, and whatever those numbers I just said added up to, 15 or 25%. Write that number down right there, because that'll be a helpful number. All right. Now we go to the next one. Which features of some fixed index annuities, also known as FIAs for short, fixed index annuity, are attractive to you? And I want you to rank these as very attractive, attractive, or not attractive. How about principal protection from market losses? Would you be interested if an FIA could offer you principal protection from market losses, where if the stock market went down, you wouldn't lose any of your investment in the FIA due to stock market losses? Okay. And I want you to go to line 33. And this is where you're going to write in which features are attractive to you. Principal protection from market losses. And you can write where's the definition right here? Very attractive, attractive, or not attractive. So go ahead and write that there in line 33. Now we'll go to line 34 for accumulation potential. Is accumulation potential, that means the ability to accumulate funds to grow potentially over time. Is that important to you? And if it is, right, very attractive, attractive, or not attractive. And the next one is guaranteed lifetime income, which is going to be right here on line 35. Is having a guaranteed lifetime income, which is available on some fixed index annuities, is that a feature that's very attractive to you? Attractive or not attractive? Next box, which potential fixed index annuity lifetime income benefits are attractive to you? And we're going to carry on, and this is going to be line 36 on your answer sheet. Income can increase following any crediting period. Allocations earn interest. We'll be able to explain this more during our meeting, and we can run an illustration for you, etc. But would it be important to you and attractive to you if you could have income that could increase following any crediting period? Allocations earn interest. That means you have the ability to grow that income and not just stay flat. And if so, in this line 35, I want you to write very attractive, attractive, or not attractive. 37, income increases are permanent. Is that important to you? When you get a raise in your income, it's permanent, and it can't go down, but it can go up potentially. Again, it depends on the annuity. We're not defining all annuities here. We're just giving a broad stroke of some availability on some annuities. We can talk specifically about your situation. But if your income increases could be permanent, such that they couldn't go down, is that very attractive to you? Attractive or not attractive? Write your answer there in 37. And 38, if your income increases can happen even after accumulation value goes to zero. That means if you drew your entire portfolio all the way to zero over time, if you could still get income and still get income increases even potentially, would that be important to you? If so, write very attractive, attractive, or not attractive in 38. Okay. So just compare that to a bank, money in your mattress, for example. If you had $100,000 and you took, I'm making this number up, $4,000 a year, you took $4,000 a year for 25 years, you have no more money left under the mattress, right? Then you go to the mattress the next day next year and you're 26, there's no money there. You have no more income from that. Whereas this, if the accumulation went to zero and you abided by the other terms of the contract, it would still continue to pay you income. Would that be very attractive to you? Attractive or not attractive? Again, write that answer in. We'll talk about the specifics. Each company, each product is a little bit different in how they work. We'll find the one that works best for you. If you're even interested, you may not be. Again, we got to see if it's a good fit between us. We got to see if we jive. If you're a client that I think would fit in with our practice, and if we're a firm that's you would like to hire to help you with your life and your lifestyle and your dignity in retirement. All right. And this last one on this page, would you be willing to commit to a 10-year surrender period? Many of today's FIAs have surrender periods of 10 years or even less, and many now commonly have features such as penalty-free withdrawals, nursing home provisions, and full accumulation value paid to beneficiaries at death. So in 9, would you be willing to commit to a 10-year surrender period, just as an example, if you had plenty of liquidity in other parts of your portfolio? Right? Yes, no, or maybe right there. And all right. So go ahead and book now. Calendly.com/portfolio protection. Calendly.com/portfolio protection. 30 minutes could change your life. First come, first serve. It'll take you about 20 to 30 seconds to go ahead and book that meeting. So you can go ahead and do it right now. You're not going to miss much. We'll get on to the next slide. Go ahead and do that before they get filled up. It's a lot of people who are going to be booking those appointments. All right. Ideally, what percentage of your assets would you like to be used to produce guaranteed income and to be subject to stock market losses? All right. 2 separate and independent questions. We're going to go to lines 40 and 41. Let me pull this up here. All right. So line 40 says, ideally, what percentage of your assets would you like to be used to produce guaranteed income? Write that answer here. Maybe it's 100%. Maybe it's 70%. Maybe it's 50%. Maybe it's 10%. Maybe it's 0%. This is up to you. We're not telling you what you should do or even could do, and we're not telling you what's suitable. I just want to hear right off the cuff what makes the most sense in your mind initially so that we can talk about it and have a good conversation. Now, separately, ideally, what percentage of your assets would you like to be subject to stock market drawdowns and economic downturns? 100%, 70, 50, 10, 0? What's that number? Again, I'm not telling you anything. I want you to tell me what you think your number is in your head so that we can have a great conversation. All right. Is this the right one? Yeah. What emotional responses might you have to the following scenarios? 1, you lose 25% in the market. I want you to think about that right now, and I want you to go to line 42. We told you it was going to be interactive. This is going to help you learn. You're going to have these answers that you can look back on so you can really understand where you are in your head emotionally, because emotion is so important to investing success, or it can contribute to investment failure. It can also contribute to more anxiety and worry, or it can contribute to more joy and relaxation, depending on how you service that emotion, how you control that emotion. So I want you to write that answer in here. You lose 25% in the market. What's your emotional response? Are you excited? Are you tolerant? Are you okay? Are you trusting? Are you nervous? Are you worried? Are you losing sleep? Are you freaking out? Are you selling everything? The next question. What's your emotional response here? You're still alive, but you spend through all your money. So you're 87 years old. You're that person who said, I want to spend through every last dime. You did it, but now you're alive. You're healthy. You've got energy. You're jumping out of bed. Your bills are $6,000 a month, but you don't have any more money. How does that make you feel? I want you to write that answer on line 43. All right. We're nearing the end, just a few more minutes. All right, all about you. So I'm just going to turn to, I'll read it off of here. Pull up your answer sheet separately. We're going to answer 44 through 60. 44, why did you decide to attend this webinar? I want you to write that in your space, 44. 45, specifically, what need are you looking to solve? Write that answer in 45. What need are you looking to solve? 46, why do you think you haven't done anything about it yet? Why do you think you haven't done anything about this yet? What's holding you back? What's stopping you? What's been stopping you? 47, how would you feel if you woke up tomorrow with 15%, 20%, or 25% losses in your portfolio? How would you feel with all those losses? Maybe you know exactly how you feel because of 2022. 48, what is your number one greatest financial concern? I want you to tell me that. What's your number one financial concern? Some people don't have any. Some people are worried about not spending enough. Some people are worried about not leaving enough for their heirs. Some people are worried about running out of money, not making enough to keep up with inflation, not maintaining their dignity in retirement. You write your answer in. 49, if you were able to overcome the above concern, how do you expect this would affect your life? That concern you wrote up here, if you were able to overcome that, how do you expect that would affect your life? More joy, more peace, more relaxation, better relationships, deeper relationships, more traveling? What would it be? Number 50, what is your number one greatest goal? Number one greatest goal, what is it? This is going to be important for you. Whether you ever call upon me for my help or not, this is going to be important for you. And you can look back on this, save this. You can look back on it years from now. I think it'll be very important for you. 51, from the math on slide 3, how does that make you feel in a loss year? So the math up here, your answer right here on line 5. How does that make you feel? All right, 52. How much of your portfolio are you comfortable losing? I want you to write that answer on line 52. How much are you comfortable losing? 50% at once? 40, 30, 20, 0? 53. Which fixed index annuity features are attractive to you, if any? And to review some of those, I'll pull them up here. 4, right here. We talked about principal protection, accumulation potential, guaranteed lifetime income. Income can increase. Income increases are permanent. Income increases even if you took all of your money through lifetime withdrawals. Which of those are important to you? Write that on the line. All right, 54. How much of your portfolio is currently protected from market losses? How much is currently protected from market losses? For some of you, it's 0. For some of you, it's 20%. For some of you, it's 50%. What's that number? 55. How much of your portfolio would you like to be protected from market losses? And if this is going fast for some of you, you can always go back and just write in your answers once we're done, and then bring those to the meeting with us so that we can talk through them. 55. How much of your portfolio would you like to be protected from market losses? 56. How much of your portfolio offers retirement income for life? How much offers retirement income for life? 57. How much of your portfolio would you like to produce retirement income for life? How much of your portfolio would you like to produce retirement income for life? Write that down. 58. If we were to help you get portfolio protection on some of your portfolio, how do you expect this would improve your life? If we could help you get portfolio protection on some of your portfolio, how would you expect this would improve your life? 59. If you haven't yet protected your portfolio, what's stopping you from getting portfolio protection? If you haven't got this portfolio protection yet, what's stopping you from getting this portfolio protection? 60. How big of a priority is it for you to talk to us about portfolio protection to possibly help you with your goals and concerns? How big of a priority is it to talk to us about portfolio protection to possibly help you with your goals and concerns? Write that answer in line 60. You are special. Each person on this webinar is different. Each of you has unique goals, fears, risk tolerance, life circumstances, etc. This webinar is neither a diagnosis nor a prescription. Together, we need to assess your situation. You probably want and need a customized solution, tailor-fit for you. Would you like to book a no-obligation consultation to explore your options? Write the answer in 61. Yes or no. Would you like to book a no-obligation consultation to learn more about guaranteed income options? Write the answer on 62. Yes or no. And on 63, tell us if you'd like to learn more about products that don't participate in stock market losses. Are you interested in learning more about products that don't participate in stock market losses? Enter yes or no on 63. And 64, would you like to book a no obligation consultation to learn about ways you might be able to protect your portfolio, to learn about ways that you might be able to protect your portfolio? Write that on 64. King me. If you had to crown one of the following as king in retirement, what would be the most important and thus be crowned king in your view? Income, principal preservation, or maximizing returns? Write that on 65. Which one do you want to crown as the king in retirement? Is it income, principal? You can only crown one. Is it income, principal preservation, or maximizing returns? Let me know on line 65. What's the next step? You book a private, no obligation consultation with me by phone, Zoom, or in person. By phone, Zoom, or in person. Here's what you can expect during our meeting. You talk, I listen. This whole webinar, I've talked, you participated by writing. I want to hear you talk, and I want to listen to hear about you. Then I'll ask questions. If I think we're a good fit, then I'll explain what I have to offer and how the process works. Then at the end, you can make a decision whether you want my help or not. Does that sound fair? Just 30 minutes. Many people spend 4 years of college preparing for 40 years of a career. Can you spare 30 minutes with me to prepare for decades of retirement? What if 30 minutes with me could change the course of your retirement? What if 30 minutes with me could possibly lead to increased joy and decreased stress? How soon would you like to start protecting your portfolio? Go to line 66. How soon would you like to start protecting your portfolio? Write your answer here. Immediately, soon, or never. Write that answer. Book now. My calendar does fill up quickly. Go to calendly.com/portfolio protection. Calendly, calendly.com/portfolio protection. Because 30 minutes could change your life. First come, first serve. Picture of my family. So grateful that you joined us today. Let me get the PowerPoint back up because I disappeared it. And from current. All right, so we'll leave that up so that you can see that. Make that appointment. Or email me at mike@theportfolioprotectionstore.com. mike@theportfolioprotectionstore.com. Go to calendly.com/portfolio protection. The calendar is filling up quick. I can just feel it. 30 minutes could change your life. First come, first serve. How quickly do you want to have a conversation about you, about your portfolio, about your investments, about your future, about your chances of success in retirement financially, chances of failure in retirement? What's going on with your worry, your concern, your desire, your need? Do you have that plan? Do you have that trust? Do you have the portfolio protection? What do you have? What don't you have? What do you need? What might you want? Let's have that conversation. Thank you and have a blessed day.